Good Monday morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamonic. How you doing, D?
Good morning, Will. How are you?
Great. I think the disclaimer's up there. You see it?
Yeah.
All
So
right.
good morning, everyone. Before we get started, keep in mind, Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor, call your broker. That's what they're there for, to give you advice, provide you with guidance. There's the disclaimer.
Excellent.
Let me share my screen. If anybody is joining us for the first time, just quickly, the reason we do this show is to answer questions you may have about Market Chameleon tools, data, or analytics. If you have questions about certain strategies or something unusual you've seen, you're also welcome to ask those, bring those up. We'll try to discuss it to the benefit of the rest of the community. You could put that question on the live chat on YouTube. Will's watching it. He'll read them back to me. If you want to come on a show and ask your question live and direct, we also provide a link to Zoom. When you click on that link, it takes you over to Zoom. Once you're in Zoom, click on raise your hand. There's a button at the bottom. You don't have to turn on your video camera. Once we let you in, everybody could hear you, and then you could ask your question, guide us to where you're looking. While we're waiting for any questions to come in, we'll start out taking a look at the pre-market report. These are stocks that are trading in pre-market hours. I also have a question from Friday left over. I could start on that. The question dealt with implied volatility skew, and I think it was in relationship to earnings.
Yeah, that was Chris was asking that on Friday.
Okay, so we'll take a look at that, have a discussion around that. If questions come in, will let me know.
I will.
Okay. So pre-market report. These are stocks that are trading in a pre-market hours. We have a list of our most active stocks, our biggest percentage gainers, biggest percentage decliners. Here I see 47 stocks made our percentage gainers list, 150 on our percentage decliners list. So from this perspective, right now we're looking like we're setting up for a bearish bias at the open. What we want to do is try to narrow down this list to get a little bit better insights. If you look at the list, you'll see small cap stocks in there, ETFs, leverage products, closed-end funds, preferreds. Any security that's listed on the major U.S. exchanges, if it meets our thresholds and it's trading at pre-market hours, it could show up on this list. And let's take a look at what I want to do is narrow it down to S&P 500 companies to get some insights what's going on there. To do that, I'm going to use the filters up here. Here's one in ETF, and drop this down. You could see that there's a list of ETFs to choose from. That first ETF, SPY, that's the S&P 500 ETF. When you click on it, the list below will get filtered by stocks that are holdings in SPY, which are the S&P 500 constituents. Here we see 3 stocks made our percentage gainers list and 24 in the decliners. So that again looks like we're setting up for a weaker opening. And of course, we had the Fed meeting last week. We had a big rally in January. Right now, we also had a good jobs report. And I think, with that, people are trying to determine, is the Fed's going to stop? Is it going to lower interest rates? That debate's going on. But right now, looks like we're setting up for a weaker bias at the open. If there are no questions, Will, maybe what I'll do is start navigating to an example of implied volatility skew.
All right, Chris is on. He asked, he was wondering if you can use a calendar spread to maybe take advantage of the skew. We please pick up on trading calendar spreads using IV?
Okay.
Was his question this morning. So
Okay.
Also, Baiju asked something. If you have time today, maybe we can get to it tomorrow. He's saying, not sure if you answered how you signal, and I think you did maybe go over it last week, mid-price as a buy or sell signal in your sentiment indicator. How do you,
Right.
if it's a mid-price, how's that taken
Right.
into consideration,
So,
I guess?
right. And you could go back and take a look at, and watch carefully, what we were talking about on the order sentiment. And when we were looking at it, a lot of people, again, reference the bid and offer of the quote versus the price. And we talked about that is not how we look at it. So the bid and offer is just one factor that we look at. It could trade mid-price, and we're looking at other factors surrounding the trade. So go back and take a look, maybe listen carefully, because if you're just looking at bid and offer, then you're not taking into consideration, the limit order book, negotiated trading, how things trade through the complex order book. You're really looking at a small piece of data, and then if you're making assessments on that, then you're going to get just in less accurate results.
Yeah, and Baiju, I just put that link to the YouTube video on the order of sentiment discussion in the chat. For those who haven't, you can register for our YouTube channel. It's a free channel, but that you get alerted to any new videos or webinars that we do. So, but there's a link to the actual video D did last week. So there you go.
So that's what exactly. So again, we're not looking at just a bid and offer. We talked about a lot of things that we're looking at, and you could go review it. But again, we did that whole show. I think that the question had to do with skew. It was the calendar spread, right? So calendar spread, you're looking at options that are different expirations, right? So let's say the same strike, but two different expirations. One is a near term, one is a longer term option. That's a calendar spread, time spread. And the implied volatility between those two different expirations could be different, right? So one could be higher, one could be lower. And typically you'll see that around earnings. And I think what people tend to look for is that, well, if the implied volatility is higher in the near term, and then it's lower in a further out term, they look at it, well, is that let's say an opportunity then to get long the time spread? Because well, you're looking at two numbers, selling the higher one, buying the lower one, and the one near term is higher, the one longer term is lower. So you got to be careful how you do that. Okay, there's a reason why that's happening. Okay, it's not an arbitrage opportunity. You're going to see it always, usually around earnings or big event, FBA meet. You're going to see it where what's happening is that the markets are pricing in a binary event. And when you do that, the Black-Scholes implied volatility doesn't price in binary events. So when you look at the Black-Scholes model, there's no input in there for a binary event or earnings or anything like that. So you got to be careful. We're going to go over it. I'm going to try to explain it, but here's British Petroleum, right? So they're reporting earnings tomorrow. So I'm going to go to British Petroleum. I'll show you what I mean by here on the options chain. So here's the options chain. These are the different expirations, right? So February 10th, we'll cover the next earnings. right? This one already expired, February 3rd expired already, February 10th. This was from Friday's close. February 10th, that's the expiration that will cover earnings. And you could see that the implied volatility at the money is 36.4. And if you go out the next expiration next, you'll see that implied volatilities are lower. So they're going lower. 36.4, 31.9, 30 and a half. And I think that what will happen is that people look at this and say, okay, well, that's a great time spread because I could buy 29.1 vol, let's say March 3rd, sell Feb 10, 36.4. So here's a skew, right? I'm selling higher vol, buying a lower vol. That's a skew because you have two different volatilities on different expirations. And some people think that they're actually arbing it, or they're getting some kind of like a, riskless trader, and that's not what's happening. Okay, but stop me if the question, but this is what I think they're looking at as a calendar spread. Okay, and this is an example of it. So first, before you understand, and I'm going to set this up for you, but what's important to understand is what is implied volatility, right? It's what is it telling us? What is this metric? And the implied volatility is run through a model, and that model has assumptions. Okay, there's underlying assumptions in the model that the stock has to trade and behave in a certain way. And in reality, in actuality, the stocks do not always behave that way. They'll behave that way the majority of the time. Okay, what I mean by that is in a normal distribution. So the stock prices, the returns will be normally distributed the majority of the time, but not all the time. One time that, for instance, that they're not going to be is earnings. And when you're taking out the normal distribution assumption, then the Black-Scholes model is not actually giving you the information that you're looking at, where one option is overpriced versus another. Okay. So what does a normal distribution mean? That if the stock price right now is 35.15, right? And we don't know, an equal chance it'll go up $1 or down $1, right? Let's say there's an equal chance that it's going to go up $1 or down $1 right now. Probability is the same. Let's take that assumption first. Well, the Black-Scholes model assumes that if it's going to move up $1 or down $1, it has to trade at every price in between before it gets there. In other words, there's a higher probability that the stock will first trade at $35.16 before it trades at $35.17. And there's a high probability it trades at $35.17 before it trades at $35.18, because it assumes before it gets to the next price, it has to trade the previous price. Okay, so if it looks like it'll look like this. I'm going to cut this. So if you start out, right, let's just say this line is the current price. So there's a higher probability, right? It gets to this price before it gets to this price, and a higher probability this price before it gets to this price, and the same way going down, right? That's the implied. That when you derive the implied volatility, this is the assumption in your model. Okay, if your model assumes that this is not correct, then the implied volatility is not very useful to you. Okay, and why is this not correct in the hold on, let me draw it again. Here, I'm gonna go back. So why wouldn't that be correct during earnings? Well, when the way earnings are reported is a stock will close at a price, right? They'll close at one price. Then the earnings is announced, and almost, and then as soon as it starts trading, it quickly moves to a different price because there's an information there that's causing a big repricing, and you'll see gaps, right? So what you'll see is, oh, a stock just reported earnings, and it's not like it opens up and then you see it slowly trading up to 10%. It doesn't do that, or slowly trading down to 10%. In other words, it's not going to start here, report earnings, and then just trade at this price, then this price, then this price, until it reprices at a different price, right? It gets there really quickly, right? After the news, it usually gets there really quickly. You could go take a look at like what happened in Meta, right? It didn't slowly go up 24%. It went up fast and kept going up fast. So it's how fast things get there. And especially around earnings, the repricing of the stock is much faster, which means that it could be more likely to hit this price or this price without hitting any of the prices in between. Okay, so it looks different, right? The probability of distribution will look different around earnings. And it would be very, you could take historical return distributions and plot them, but it's not going to look like a normal distribution. You could do that to many earnings, and you'll see that that's not the case. So since that's not the case, that means that this implied volatility here, right, will give us a bad indicator of, the pricing of the earnings effect. Okay, so that's why you can't really use this 36.4 versus 29 as a way to evaluate a time spread around earnings. It's not enough. It's not telling you what you want to know. So far it's very important if you're looking at time spreads, and that you have to take into consideration, are there any binary events that will cause the stock to move very quickly to a new price? Okay, so let me know if that's so far.
So far, so good, D.
So far, so good. Okay. And by the way, you're gonna see kind of this situation around almost all earnings. I'm not saying 100%, but most of the time, this is what you're gonna see: implied volatility higher and then lower here. And that's not because options are mispriced. They're pricing in a binary event that you can't use the Black-Scholes model to work your way backwards. Okay, so that's the idea. So let's take a look though at this calendar spread. The setup would be, let's start with February 10th, right? And you have an option here, February 10th. Let's say the 35 strike. You could see here that the bid is 34.6, which is 77 cents. So let's start with that. We sell that, right? Sell this, and then we'll come back out. Let's go to February 24th, 30 vol, right? So I'm coming back out here, and you can see here, this is 31.4 vol for $1.04. So let's say I buy that. So here's the spread. This is a calendar spread. Selling the Feb 10 35 call for 77 cents, buying the Feb 24 35 call for $1.04. So same strike, different expirations. And you can see the prices are different. You're not buying. Now, if you could buy the Feb 24 strike for, cheaper, not implied volatility, but cheaper notional, then we're talking about a different story. But you can see there's a difference between the premiums, right, between the Feb 10 and Feb 24. So let's calculate that. And here it is. If you did that on the prices we were just talking about, it'll cost 27 cents. So here's the bid and offer of the spread, 17 cents, 27 cents, midpoint 22. If we did it at these prices, that's 27 cents. That's what you're paying for in the spread. Now, here's a couple of important Greek metrics here. What happens in this situation, right? We have it's a slight delta. There's a short gamma, okay? So what does that mean by short gamma? It means that the more that the stock goes away, the more delta risk you're gonna have. So you're short gamma, right? So you're getting longer deltas as it's going down, again, shorter deltas as it's going up.
Hey, D, we did have a question previously. Can you just show again where the delta is shown? Because I know Mike was asking, when you price a spread, where can you see the delta? Just
well, right here.
All right.
Like once I ran the calculator, it's right here. So this is the delta of the spread, okay, which is negligible. The delta at this point, let's say it's delta neutral, basically. This is telling us that there's a negative gamma. So negative gamma means that as the stock moves, right, you're accumulating deltas that are, contrary to the move. Basically, you're getting as it's moving down, you're getting more and more long deltas. As it's moving up, you're getting shorter and shorter and shorter deltas. Okay. And for that, you're getting a positive theta. Basically, there was a decay. And here, this is an important thing. You see here, your long vega. So what this spread is telling us is that, yeah, you bought it, you sold a higher implied vol and you bought a lower IV, but the lower IV you bought, has more days to expiration. It's a longer duration, meaning that the vega of that option is higher. So on balance between the two, you're long vega. So if implied volatility comes in, in equal amounts on both options, then you're losing because you're long vega, right? Okay, that's what the position is. You're actually, you're even though you sold one and bought one, you bought an option that is more sensitive to a one vol click move in vega, in implied vol. All right, so we're long vega here. Now, this chart here shows, what the payout would be, the profit and loss on February 10th expiration, if on February 10th, the implied volatilities are the same as there. So this one, obviously February 10th, the implied volatility won't mean anything because that option will expire, but this option still has days to go. So what is the implied volatility of this one? What will this be on February 10th? Okay. And we could do it the next day, but let's just keep it at February 10th. If you want to change, I think right here, if you want to change the dates, you can do it here. Let's keep it at February 10th for now. So on the surface right now, it looks like, well, this is not so bad because as long as the earnings fall in this range in the green, these are the last 12 actual earnings. So you can see like the earnings can fall outside into that red. See these lines? All these lines are looking at the last 12 earnings, percentage moves and plotting them for you to show if that happens again, where your profit and loss will be. So you can see, I mean, to me, it looks like half of them landed in the green, half in the red. So, but let me take that out for now. But the green areas here from 36 to 30, 34, like $1 around. But that assumes that implied volatility doesn't come in, and February 10th, the implied volatility won't matter, right? Because that goes to parity. But we know that the implied vol will most likely come in, and what will be the new implied volatility of this? We could estimate that. So I could look here, or actually, hold on a second. I have it here. So here, the IBKR. This here is showing us. I'm going to do the IBKR because we already did all the work for you. So, given the similar situation for previous earnings, right? If we had to price this spread based on historical values, okay, so this is looking at historical values, converting them to actual values using historical IVs and premium over parity and so forth. This option on average was priced at 25 cents if we given the same strikes, same distances of expirations away from each other, same distance of the strikes away from the spot price. So basically, it's looking at the similar benchmark in a similar situation, just around earnings. Okay, so you could see here it's using just last 16 earnings. Okay, it's taking all the other stuff out. So here we get a sense of historically where was this priced. So you can see here it had a big range, on average 25 cents. And this payout diagram will say this is the profit and loss calculator saying historically where were the implied volatilities after the earnings, given the similar dates to expiration that we are now. So this is what it would look like here. Okay, so this is taking down implied volatility. See, February 10th expiration. So February 10th expiration, the first option has 0 implied vol. This is where it is now, right? So currently, and you can see historically, but this is on February 10th, the option number 1, implied volatility is 0 because it expires. It's just going to work parity. But option number 2, well, what would option number 2 implied volatility be? That's right now we need to create an estimate, guess. And this is using historicals to say, okay, right now we're at 35.2, right? But on February 10th, we believe the average volatility historically was at 30.9. Okay, with the median 50th percentile 29.6. So this is drawing you the payout diagram, given assumptions based an educated guess based on what implied volatility did historically, pre-earnings and after. Okay, so where do we think those options will be after? So if we give it the 50th percentile, this is what it looks like, your payout. But you could change that, right? You could say, I think it's going to be on the higher end. You could rerun that, right? So this goes up, it goes on the lower end. You could reprice it, it goes down. Okay, so this gives you a picture of potential outcomes that were based on what the stock and implied volatility did historically around earnings. All right, so we're right up at 9:30. Well,
nice job, Dino. We did have a question from Michael McCrae. I'll send it over. Maybe we can look at it tomorrow. Great job, my friend.
All right, everyone, thank you so much for joining. Stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Thanks, D. Trade and Peace, Chameleon.